the most powerful setup in the weekly setup, the 3-day swing, is the multi-session M and W. In the previous lessons, I said to you, with the weekly setup, there are really only 2 trade entries. It might be 3, but generally 2. What I just said to you is one of them, the multi-session M and W. So let me explain what this is. The market maker hits a level. You can see this on the screen. The market maker hits the level, and then they repeat the level in another session or in another day. So it could be in the very next session, it could be in the session after, or they may not come back to it to the next day. But when they repeat that level, they fall short, and they do that on purpose because they've trapped volume or limit orders at the initial peak. And if they come all the way back to that, those traders can get back out at break even, and that takes the market maker's liquidity away. The market maker knows that for the most part, majority of retail traders, when they're in a wrong trade, instead of taking a loss on that and just resetting, they will hold through it and cross their fingers and hope the price comes back to their entry so that they can get out at break even. They convince themselves that's going to happen. Now, after the initial move is made and price pulls away, and then it starts to return, which is creating the left side of the M, that's where those traders start to think, see how smart I am? I'm going to get out at break even. I was right. And they won't take that little loss. They will hold it all the way till it's exactly at break even so that they can get out with no loss because they think that loss is bad. But the market maker doesn't come back to that level on purpose, knowing that they won't close unless they're at break even. It gets close enough to it, the traders stay in their trade, waiting for break even, and then the market maker shifts price swiftly down into a level 1 drop, keeping them trapped the whole time. So that's what's happening in an M and W formation. Now, the market is based on a 3-day, 3-level cycle. I keep repeating this on purpose in case you haven't noticed. I'm trying to point out that it's not always 3 levels. It can be 3 days. So 3 days or 3 levels. Therefore, if you're trading the weekly setup, then the formation that is going to be the most probable for you is the multi-session M or W. Now, these are even better if found at the highs or the lows of the day or the week. Again, something will be covered in future lessons. So here's how this would typically look. Looking at this chart, we have the false move week beginning, that spike high that you can see there in the middle of the screen. After the false move, price goes back into consolidation or a retracement, which we can see after that move away, we headed back down towards those EMAs. And then during this time, they could spike high, spike low. In that time, the market maker is accumulating and evaluating the contracts and the money that's on the table. When you see a W or an M formation, that means the decision has been made. So if you get a spike that creates the first peak in one session, and then we don't come back close to that level until the next session or the session after, that's a multi-session M or W, and that's your highly probable trade. In this example on the screen, the first peak was created in Asia. You can see by the dots down the bottom, and the second peak actually started at the very start of UK. That is actually the perfect spot for an M formation. It will almost guarantee you a 3-level drop to follow. So your entry would be on the second peak of that M, but we'll get exactly into where to enter and exit trades in future lessons. But then you'll watch for your 3 levels to play out. Ideally, they will line up with the high or the low of the week or the day on the opposite side, or they will break it and create a new high or low. Once you identify your 3rd level and a stopping volume candle coming in the candlesticks lesson, you can take your profit and the trade is done. The patterns are the same no matter what time frame you're looking at, but a multi-session M or W will look very different on a 1-hour chart compared to a 4-hour chart, for example. So on the 4-hour, an M could be tweezer tops because it's over 8 hours, but on a 1-hour chart, that same M could be a peak followed by a retracement, then a return to a lower high that is the second peak with an inverted hammer, for example. So they can look very different on different time frames. The W or M, when it's formed, will be very aggressive, but once it's done, you'll get an aggressive move out of it. And that's why if you can catch the right M or W, you should end up in profit very quickly. The spikes in an M or W should pull away quickly. This is how the trap happens. Then they come back, but not as close to the first peak. This usually happens when the 50 and 200 EMA have widened also, as this is when retail anticipates a continuation move up. If you find an M or W on the 1-hour chart, you'll most likely now have a weekly reversal. This allows you to set a fairly tight stop loss with an amazing risk reward. Once you understand the market maker's moves, you can hold through 3-level rise, but whilst learning, you shouldn't hold through the board meeting. The reversal is imminent if the price rejects the 200 EMA with a hammer. So you would take some profit, or if you're learning this, you should take all profit there. Don't take those 200 EMA reversals as a newbie. Almost always a false move to jam traders. The aggressive move does not always give you a nice retracement to counter trend trade. Let that play out and look for the weekly setup level 2. So just to be very, very clear, if you have this M formation that you're seeing on the screen and then price drops away to level 1, once it's broken the level 150 EMA and it makes its way to the 200 EMA, If you see price starting to reverse at the 200 EMA rather than just go sideways into a board meeting, don't open a long position there, because all that is a retracement after level 1 to take price from the 200 EMA sometimes back to the 50 before continuation to the downside. And the thing is sometimes price doesn't make it all the way back to the 50. If price is very bearish, it might only go back to the 10 or the 20. So it's a very poor trade and just not worth it. And not only that, it may look like it's retracing, but it only retraces a little, then goes into a board meeting. So it's just a very low probability trade. And instead of trying to counter trend trade after a level 1 rise or drop, you're better off letting that retracement, if it happens, you're better off letting that retracement happen, then jump on for the next rise or drop that is going to be due after. That is going to mean waiting patiently for that entry, but it's a much more highly probable trade than trying to counter trend trade from 200 EMA back to 50, because there's no guarantee that it's going to get back to 50. If it ends up being a retracement, not a board meeting, that's why you're better off just letting that retracement play out. In the board meeting, look for fake out spikes. And again, I'll show you what those actually look like in detail in this course. Validation comes only when the candle closes at the end as a hammer. This is why you must wait for candle closes to take an entry. Stop losses go below the low of the candle, of the previous candle from the first spike, or the low of the day if it's in a W formation, or above the previous spike and above the high of the day if it's an M formation. After the W or M, they will immediately shift price away to cause damage to those that they trapped. A vector, which what you're seeing on the screen is the colored candles. A vector, basically in a nutshell, is retail perceived momentum. People believe that retail are jumping on and pumping price in one direction, or jumping on and selling off super fast. It's just perceived momentum. That's not what's actually happening. Once the fast move out of the W has formed and the pullback into consolidation happens, the pullback is designed to take out people who longed too late but were actually right, and the consolidation is designed to create false sense of security for those that shorted and are still holding on. Ending in consolidation means that business is done for the day for the market maker. They have done their damage. Consolidation is like a tick of approval for the market maker. So if you see price in consolidation, you know they just hurt someone and the job's done. This is everything I just spoke about is all only up to rise level 1. Then the next level or the next day, you would expect a stop hunt rise for level 2, or drop if it's going the other way. And this is for the next 2 days or the next 2 levels, but sometimes the timing can change. So you have to be aware that these can happen anytime. For example, there could be a session shift and it could happen in Asia, when Asia typically does not actually run a trend. So now that we know the levels that must come with higher than average volume, we need help to figure this part out. So let's go through some features of the TBD indicator, which you have access to as an active TTC member.